Hello traders, you're welcome to this video. This video we are going to be discussing the MACD. We're going to be discussing one of the best MACD trading strategy that you can use to improve your trading decisions. So basically to master the MACD trading strategy, we are going to be looking at a detailed step-by-step breakdown of how to use this indicator. Now first of all, let us just add up the indicator to our chart. MACD indicator. Okay, um, just add it up to our chart. Now, the moving average convergence divergence, which is the MACD, is a momentum-based indicator that helps you spot changes in the strength, direction, momentum, and duration of a trend. So basically, it is a momentum indicator. Traders usually use it to check the momentum of a buy or the momentum of a sell, and it also gives buy and sell signals respectively. Okay, now the MACD line. It is, you can see that the parameters of the MACD, they are as follows. We have the fast EMA, the slow EMA, MACD SMA, and these all make up what we see here. While the MACD line is the difference between a fast moving average, you can see this is the fast moving average. In this particular settings, we are using the period 5, but the MACD line is actually the difference between this and this, the fast moving average and the slow moving average. It is the difference that gives us the MACD line. Okay, and then we have the MACD SMA also. We are using the settings period 5. However, you can just decide to use the default settings. That is also going to work for you. We have discussed MACD in previous videos. We have discussed um, some of like the best settings you can use for different trading time frames. So you might want to check out those other videos, and if you want to get more information about MACD settings. Okay, so basically you need to set up your MACD on your chart, and then after that, obviously you need to know how to identify buy and sell signals. So how do you identify buy and sell signals? It is when a crossover happens, crossover between the MACD line and the zero line, this horizontal zero level. So when you have a bullish crossover, it's a buy signal. And then to add to the momentum, when you begin to see long histogram bars, it shows that the bullish momentum is quite strong. On the other hand, when you have a bearish crossover below the zero line and you begin to see long histogram bars below the zero line, it shows a strong sell momentum. Okay, so now when you see that crossover happen, you can decide to enter a sell at first. Then when you now see long histogram bars, you can now relax for a bit because you know that the momentum is quite strong. However, if you see a crossover and you enter a buy and then you begin to see that the histogram bars are short, you might want to exit the trade because it shows a weak momentum. As you can see in this example, after the crossover happened, we can see that if we had entered a buy initially, you can see that these short bars shows that the momentum was weak, so the market was ranging. So after ranging for a bit, you can see that um, it continued ranging all till this point because the MACD line was still above the zero level, and then finally it sold. You can see at this point. So we would have just exited our trade as we saw that the histogram bars were short in length. Okay, now another way that traders usually use the MACD is divergence. Okay, divergence usually occurs when the price action and the MACD indicator move in opposite direction. Now we have already discussed divergence also before, but just just to explain all that we need to for this particular video, I'm just going to do a brief recap about that, right? So now a bullish divergence occurs when price makes a lower low, okay? Price makes a lower low, but the MACD makes a higher low, right? Now we can see this, though this was brief, this was quite brief. Let's just look for another example. Price makes a lower low, but the MACD makes a higher low. Let's look for a good example for that. Now, the divergence is not something that occurs all the time, but it actually occurs, right? Might not see it always, but it occurs. Okay. Let us look for a good example. Just hope that I found one. Okay, this was a very brief one. We can see that price was making lower low just at this point. No, this is not exactly it. We need something more obvious. Okay, I think this can work. All right, now we can see that price was making a lower low around here, but the MACD on the other hand was making a higher low, right? So this could indicate a potential reversal to the upside, as we can see that after a while the price began to go up, and we can see that price eventually went up more than where the divergence occurred. Okay, now the bearish divergence is just the opposite, when price is making higher high but the MACD is making lower high. In that scenario, it suggests a potential reversal to the downside. Now, some of the common mistakes that you should avoid when using the MACD is to rely solely on the MACD. It is important that you use MACD in combination with other indicators. Although you can use MACD alone to gauge your momentum, your bullish momentum and bearish momentum, and to also get signals, but it is also advisable to use other indicators in addition with price action for extra confirmations. Okay, and just like all moving averages, the MACD is a lagging indicator. You know, the MACD works with moving averages. We can see the fast EMA, exponential moving average, slow EMA, exponential moving average, MACD SMA, simple moving average, right? So it works with SMEs, works with moving averages, okay, that forms this thing that we're seeing here, and it's a lagging indicator just like all moving averages. So it is also good that you confirm with price action. You might want to pay attention to candlestick patterns, you might want to pay attention to chart patterns, and you also use your support and resistance levels when using the MACD indicator. Okay, and you can also decide to combine with the volume indicator just to add to, extra confirmation, knowing when volumes are high in a particular point in time. And you can also decide to go to different time frames, although that depends on the kind of trader that you are. Okay, but remember that the smaller the time frame, the more prone the indicator is to giving false signals. So when you're working on the smaller time frame, you might want to be, of course, you have to be a scalper if you are using the smaller time frames. Then you might want to be like getting in and out quickly, in and out of trades quickly, right? So that you don't end up turning a winning trade into a losing trade as a result of a change in direction of price, because the MACD might lag even more on the smaller time frame, or it might give more false signals on the smaller time frame. However, irrespective of the time frame that you are using, the signals, the things to note, the crossover, the histogram bars lengths, and the upward and downward movement of the MACD lines, the signals basically remain the same irrespective of the time frame. And one thing that you should know is patience is key. MACD is more effective in trending markets. yeah, if you want to get the best out of the MACD indicator, you might want to use it in trending markets and avoid using it in choppy or sideways markets where the indicator might give more false signals. So by mastering all these elements, you'll be able to use the MACD as a powerful tool in your trading strategy. I hope you found this video insightful. Kindly like and subscribe for more. Cheers and happy trading.